Our next guest is expecting those cuts to have a summertime kickoff. Let's bring in Saira Malik, Nuveen's Chief Investment Officer. Saira, welcome. Good to see you, and thank you for joining us.
Nice to see you.
So you expect rates to take off later this year. Where do you think the S&P will end the year? I mean, usually election years have 10%-ish returns. What do you think this year?
Well, our price target for the year is actually $49.50. But look at year to date, it's been the strong economic data and technology earnings that have driven the markets higher. We're actually trading at about a 15% premium to average on the S&P 500. And I see three headwinds in front of us that may keep us around this level of under 5,000 or around there. And that's what's the catalyst to take stocks higher from here. Also, yields are now crossing 4% and Fed commentary. So just starting with Fed commentary, we came into this year, markets were expecting 6 to 7 rate cuts. Our view has been 3 to 4 rate cuts starting this summer. It looks like we're moving towards that direction. Tech earnings have been very strong, about 60% growth year over year in earnings for the big tech companies versus overall S&P earnings running more 4 to 5%. With all of those companies reporting, I'm not sure what the catalyst is from here. And then, of course, a headwind with yields over 4% on the 10-year.
So let me come back to you and invite you, if you're of a mind, to change your year-end outlook on the S&P 500. It's now at 49.93. Your call is 49.50. It's obviously gone up about 4.7%, almost 5% already this year. Does that make you double down on your 49.50, which would suggest basically flat for the rest of the year? Does it make you want to go, I could go to 5,100. Do I hear 5,200? Do I hear 5,300? What?
Well, for now, I'm sticking with it because the key to the S&P this year is going to be, can the economy hold up in the face of these higher interest rates and inflation? Key to the economy is going to be consumer and employment markets, which do remain very strong. Consumers been spending, but we are seeing higher delinquencies with the consumer, higher credit card delinquencies, higher auto delinquencies. If we do get closer to that recession later this year, that will create more volatility for the markets. And let's not forget, it is a big election year, not only in this country, but 77 countries going to the polls this year. 60% of GDP will be voting this year. Markets tend to get more volatile the closer the race is in the U.S. I think we are going to have a close race in the U.S. So I see more volatility ahead from here. I don't think every month is going to be as easy as January was.
Saira, if I can sort of wrap together some of your thoughts here, you've called out strong economic data, particularly when it comes to employment and the consumer, at least in the spending, though I hear what you're saying about possible delinquencies. If that's true and the economic data is still strong, why do you then think that we need 3 to 4 rate cuts this year?
I think the Fed will focus on keeping real rates stable. And so the other side of this equation is, of course, inflation, which had been looking pretty promising with PCE coming in fairly soft. But then, of course, wage inflation in the payroll data was up 0.6%, which is worrisome. But, of course, inflation has moderated overall. I think the Fed cuts to just keep real rates stable for now, and there's no need for them to rush to cut. But if they don't cut at all, then technically that would be continuing to tighten conditions. And I don't think that's their goal either, since inflation is moving in the right direction, but they want to see more evidence before they start cutting rates.
Where are you looking to put money to work, or where would you advise clients if they have sort of cash on the sidelines and they'd like to try to make some money, even if the environment is dynamic with this upcoming election here in the United States and other turmoil around the world in both elections and, frankly, geopolitical concerns in the Middle East with what's going on in the Red Sea and Israel and Hamas?
Yeah, definitely a lot of issues to consider, but you're right. A lot of cash on the sidelines still sitting in money market funds and T-bills. So areas that we're looking are more conservative and resilient in an economic slowdown. Infrastructure stocks tend to be more resilient because what's within them is waste management and utility sectors. We also like dividend growers, companies that consistently grow their dividend over time. Switching over to fixed income, municipal bonds look interesting because states are so strong right now with rainy day funds, and then higher quality fixed income like investment grade. I think that's where cash goes at first to get out of those T-bills into potentially higher return areas with limited additional risk.
If Kelly were here, she'd be excited about that muni bond recommendation. Saira Malik, thank you so much.